last week that I want to, and I'll share on the in a WhatsApp channel as well, that with this module, I want it to be kind of practical, especially for those that haven't started investing yet. My goal is to have everyone invest their first 100 Rand by the end of this module. So yeah, I'm still going to communicate that, and we're going to pick a platform, and we'll all like kind of invest together, and all of that will be like a nice little exercise to do at the end of the module, just to kind of get everyone started on the investment journey with 100 Rand, like, you know.
Okay. I wanted to ask something because I did watch the video of last week's lesson.
Yes.
I need to ask, how secure is the initial investment amount with like the whether it's S&P 500 or the London one or any other country? Because all my money is with South African banks, and because they give you that small portion every month for your money, it's not a lot. African Bank is doing much better than the other banks because 2 years, like 2 year long investment, because I put in like lump sums. I don't invest monthly.
Okay.
So they would give me like 8 to like 11%, with a 2 to 5 year returns. And you know what's funny? Because they would say it's these investment accounts, they are taxed. But I don't know whether, whenever I calculate on my own, I'm just like, when do they take the tax amount? Because the 8% that they're talking about, when I do my own calculation at the end of 12 months, I get the exact amount or even a little bit more. Because I'm just like, okay, are they telling me
So
about the 8%?
what is the return you're getting? You're getting an interest return? Are you getting a dividend return? Like, what's the type of return you're receiving?
It's an interest return.
Okay.
And it's compounded because it stays in the same account.
Okay. So with an interest return, there is the tax limit of, I think, 23,800. If you earn interest within the tax year of up to that amount, you don't get taxed. Anything above that amount will get taxed.
Oh, now I see. Okay. Do they look at it per account? Because sometimes you find that you've got 4 or 5 different accounts under your profile.
Yes. So they will combine your entire return. You will see all of your savings accounts or all of your investment accounts that give you an interest kind of grouped together, and it will kind of calculate your returns. And then you will kind of see when you are doing your tax return at the end, they will take that rebate off, and then whatever is above that then will get taxed, will form part of your taxable income. Because
that's
remember,
I'm gonna have a look at that, because I was just like, wait, like, does this mean I owe SARS in a way? Because if they say 8%, that's exactly what I'm getting, and I've been investing since 2019, and like each year I get exactly that amount that they calculate for you when they actually convince you to put in the money. You know, the whole calculating that they have in the system, I get exactly that amount. And I'd be thinking to myself that there should be a way that I'm actually paying tax out of these investments. But it just, like, it's not clear for me to see. Like, I keep asking myself, when am I paying? How am I paying this tax? Where do I pay it?
So remember, the returns that you would get goes towards your taxable income. So in a year, your taxable income will be whatever the amount is. And for different things, there are certain rebates that you get, like money off, so you don't pay tax on that. Anything above the rebate would then be added to your taxable income, and then you'll be charged tax based on your tax table, for example. So the first thing that would happen is they would add all of your interests and your investments and your whatever you like. If you open your tax return and they submit that information on your behalf, sometimes they might send you a statement, an IT3B statement, I think it's called, or an IT3A statement. So they would email it to you. And then in that statement, they would show, okay, these are contributions, this is the interest. And sometimes they'll even add the tax codes of where that amount needs to go on your tax report. So when you go in your tax report or your when you are submitting your taxes, you should be able to see those amounts reflected. If they're not, then you need to add those amounts in to calculate your tax correctly. So what would happen in the sense of interest earned, that rebate, 23,800, I think is the rebate. So any interest that you earn that's up to 23,800 is not taxed. So if you earn interest less than 23,800, you're not going to get taxed. But anything above that gets added to your taxable income, and then you would get calculated based on your tax table how much tax you would owe. Yeah, so that's why you are not able to see it, because it's something that you would calculate at the end of the year, or when you are submitting your tax return.
Okay, I'm gonna have a look at it. Then I'll tell you in the WhatsApp group if I see what you're talking about.
Okay, cool. Yeah, just have a look, and then it's always best to also the statement that they email you. That has the report for the year, so they should email you IT3A statement or IT3B statement. Just check it against what they've submitted on SARS, because sometimes they will submit it on your behalf, and it should show up in your SARS tax. What is it called? Gonde, that tax thing. It's not clear the name. But when you are doing your taxes, then you should just double check if those amounts correlate, like they equal, because they can sometimes make mistakes, either inflate or understate that amount.
Okay, thank you so much.
Yeah. Cool, no problem. Welcome, guys. Let me share my screen. So last week we started the investing conversation and we introduced that. This week we are looking at how to start investing, beginner's guide to building wealth. There's quite a few things we need to cover today, so we're gonna get just right into it. As always, if you have a question, just feel free to interrupt me as I'm going through the lesson plan, because I unfortunately can't see your guys' comments whilst I am going through this. So I mentioned last week, or in the ending of our last lesson plan, is obviously we were wrapping up the saving conversation, and then our last lesson plan was saving versus investing. And last week I did mention, if you did watch the recording from last week, in last week's lesson plan, is that this is the one lesson plan or conversation where people say, investing is where you build wealth. You're not going to build wealth by just saving money. You need to invest. And we kind of explored what that means and why are the differences. So as a beginner, someone who's never invested, someone who's been thinking of investing, it can get very overwhelming, because there's just so much that pertains to this conversation and this topic, and it can become very like, I don't know where to start, because there's a wealth of information. And so we will try and break it down in this lesson plan to make the information easily digestible, but also to bring about an action at the end of this. And I was just sharing earlier that my biggest goals for this lesson plan is for all of us at the end of the lesson plan to invest 100 Rand. So for some of people, it would be investing their first 100 Rand. For others, it would be just investing 100 Rand because they already are investing. And then we can kind of all share and do it as a collective exercise that I think would be really great to do as a group. But I will share more information on this maybe tomorrow on Friday in the WhatsApp channel and on email as well, just so everyone is aware and we can all do it together. So when it comes to investing, there are many layers to it, right? There's many ways to go about doing it and investing. A lot of it is rooted in education, kind of having some type of understanding on, the topic of investing, the topic of returns, what to invest in, things that are available to invest, and all of that. You don't need to have an in-depth knowledge and just know everything from front to end, but it's good to have some type of understanding, especially if you're wanting to build an investment portfolio and you're wanting to invest for the long term. You want to really have an understanding and know what are the things you're investing in, why are you investing, and all of those important kind of questions. So the first one would be to set investment goals. I always say, remember in our first lesson module, the budgeting module, we did look through and we worked through the money mindset journal where we were, kind of asking ourselves certain questions when it comes to our financial journeys and all of that. And it all goes back to why. If your why is very clear, doing something becomes a bit easier because you're very clear on why you are doing it and why would you even put an effort in doing that specific thing. And so it's crucial to understand why you want to invest and what are you hoping to achieve from your investments. Investing is really great and good, but just knowing for yourself, why am I investing? What is my plan? What is my goal? What do I want to achieve from me investing is going to help kind of meet or answer quite a lot of follow-up questions after that. Because, for example, here, just kind of knowing a short-term versus a long-term goal. If you're looking at a short-term kind of investment goal, the type of products and things you invest in will then be suited and tailored to that short-term goal. Whereas if you're looking at something that's more long-term, you will kind of look at things that you can withstand or can give you those long-term returns or have more risk attached to it, because long-term is always seen as it's good to put more risk in something that's long-term because you can withstand kind of the fluctuations of the market and all of that. Something short-term, you don't want to be putting it in something that's very risky. You want to kind of put it in something that's going to be a low-risk asset so that you can protect as much your capital as much as possible. So it's important to kind of note that. And the time frame for short-term is usually 1 to 5 years. Long-term 5+ years, and kind of the things that you would invest in, these two different things would differ because of that. The SMART goal concept, just kind of specific, what is it that you are wanting to achieve? Is it measurable? Kind of having something where you can track. And I did mention I'm currently working on a template to help you measure and track your investments and your portfolio. I'm still kind of working on it and putting it together. I don't want it to be too complicated. I want it to be as simple as possible so everyone can use it and so it can be user friendly. But, having something to measure and track, is it achievable? It's really great to also, if you are setting these type of goals, to set realistic goals based on the timeline. So whether short-term or long-term, keep it realistic, relevant. Why is that goal really important for you? And I think when we come into the topic of investing, it can get very noisy really quickly, especially with people sharing what they're investing in online or just hearing different investment information pop up. It can become like, oh, maybe you're missing out. And I have experienced this way. I would go online and see, someone, maybe another creator who's in my, financial space, share that they've invested in a specific share or whatever it is, and this is what they're getting. And sometimes you can have like that FOMO of, oh my God, did I miss my chance? I should have invested in that. And I have, made those mistakes in the past where I would invest in something because I saw someone else invest in it. But then when I look at it in my portfolio and in retrospect, I realize actually that's not my strategy. That's not my focus. That's not something I should have done, and kind of take it as a learning curve. So it's really important to always like, okay, cool. I appreciate seeing that information, but how does it apply to me and my goals and what I want to achieve? And so that's why the SMART system is really great in just helping you define and determine some of those questions for yourself. How long do you have? Time horizon is also really good to answer. A lot of the times, older kind of people, maybe nearing retirement, who are investing for the first time, so maybe someone in their late 40s, 50s, their horizon is much shorter. So the things they'd invest in is very different as opposed to someone who is in their 20s, just starting out a new job, or maybe even in your 30s, looking to invest for the first time. Your horizon's a bit different as well, but also your risk profile and risk appetite. And we looked in depth about risk in the previous module, in the previous lesson plan, but also all of those things are really good to consider. And when we look at short time horizon, for example, one of the examples I can give for myself is I have an 18-month-old. He's starting school in like a year-ish. So he's turning 2 next year. So we want him to start school when he's going to be turning 3. And so next year, we've kind of set up that we want to save and put away money for his schooling, but we want to try and be a year ahead every year. So we want to save his school fees a year in advance so that at the beginning of the year, we can pay upfront and in cash. And so we are trying to and looking at investments, or not particularly investment, but kind of help us become, that will help it be more liquid, and something that won't penalize us for wanting to withdraw quickly or in a 12-month period, for example. And so for that, we are now exploring and looking at other ways that, okay, we need to have a short-term type of plan, but also we need to start thinking about when he goes to high school and varsity, those will be more long-term kind of plans. Where are we going to put our money? What is going to be our focus? And kind of looking at those two different scenarios, because the one needs to be liquid. We need to be able to access it easily and, you know, use it for his schooling now up until primary. But the other one can be more long-term for the future when he's like starting high school and varsity as well. So those type of things can also help you determine what products and what assets are you investing in that can help meet those needs that you have. Risk tolerance is really important. And we spoke about this in the last lesson plan as well. High risk tolerance, you know, type of assets are things that are very volatile. So like stocks, cryptocurrencies, mainly cryptocurrencies because of how they fluctuate. Low risk would be things that are more safer, like a savings account, a bond. You know, those have less risk. Money market account as well are more low risk tolerance type of investments. But also remember, low risk, low reward, high risk, high reward type of rule. You know, it's not set in stone that that's always the case, but a lot of the times those rules apply to those type of risk accounts. Prioritizing your goals, just understanding what is essential and what's kind of discretionary. So this example here is saying, you know, something that you might see as essential, saving for retirement, because you need to have some type of retirement savings. When you do want to retire, you need to have some money to help you live, continue to live. A child's education, that's a big essential for us. And a big focus for us in the next coming year to just prioritize all of our savings, all of our investments, and kind of direct our focus into that, because, you know, education is very expensive, especially if you want to take your child to those schools that do cost, that are quite costly. And then discretion would be things like, you know, putting money away for a vacation, or maybe a renovation project, or upgrading certain things, you know. So different things and different seasons of your life will kind of call different results, or kind of call for different focuses and specificity. And then just starting with high priority goals. I know it can get overwhelming really quickly. And we were chatting a few lesson plans ago with Unogwanda about how sometimes it can feel like there's not enough, like there's more life than the money that you have. Like life is exceeding the money that you have, because you need to do all of these things and what you have available is not enough, right? And so it can get very overwhelming really quickly, because you might look at things and be like, well, my priority right now is not really investing, or it's not really doing that specific things, but I know it's the right thing to do. And so you can feel under pressure and feel like maybe you're getting left behind and time is kind of going because you haven't started that. And I always say that I follow this 4-pillar method, which is how we are actually structuring these modules, which it starts with the budget, which is the, you know, kind of the foundation for your financial success, where you allocate and have a plan for your money. But then the next thing, or the next priority, is to focus on any high interest debt and getting rid of that debt, and getting that money back into your cash flow again. Because if you are paying off your credit card that's charging you 20-something% interest, you now can get back that money into your cash flow. Then the third thing is to build up some type of savings. And we spoke about the solution fund in the last module, where it's having 1 month worth of you know, essential living expenses. So your absolute needs saved up, knowing that at least you've got a month saved of just the absolute essentials that you need. Once those things are ticked off, then I think, okay, now we can start introducing the conversation of investing to the conversation, because now you've kind of taken care of, I would say, the higher priority goals and the more important things that would kind of contribute more towards your financial goals and your financial peace and financial security. Then focusing on investing, or trying to do all three at the same time and feeling overwhelmed and feeling like you just don't have enough for yourself at the end of the day, right? And so that's why it's important to go through the steps of setting your goals and being clear of what is important and what is priority are you going to be following. And so that's why I always say budget, pay off high interest debt, or get out of debt, save, have some savings put away, then invest. For me, I did all three simultaneously, but I wasn't overwhelmed by my debt. I didn't have a lot of debt, so I was able to save. I was able to save, invest, and pay off the debt that I have. And now I'm in a position where, okay, I have no debt. I'm now able to save more, but also for the season that I'm in as a freelancer, as someone who is essentially self-employed, I need to have more to do investments and all of that. So in the season, my contributions look very different based on compared to when maybe I was working a full-time job and being able to allocate more towards my investments. And so you need to also assess where you are right now. What is the current season requiring from you? And then kind of assess going forward. So this one is saying like annual reviews, and at least once a year, review your progress towards your goals. Especially if you're trying to build that savings in a nice cushion. Are your investments performing as expected once you have started investing? Are you happy with what's happening with your investment? Are you happy with your retirement fund and all of that? Do you need to adjust maybe your contributions, or do you need to adjust your portfolio setting? And we will look at that on how to build an investment portfolio. And then life changes, as I mentioned. There's certain things in certain seasons in your life that will call for different things and different priorities. And so things like getting married, having a child, changing jobs, can change your financial goals and what you focus on. And so you need to be able to adjust accordingly, but also prioritize things that make sense for you and your financial journey. And then once that is done, I think then the next question would be, okay, now I know why I'm investing. I know my timeline. I kind of know what I want to achieve. If the response from all of this is, okay, I am able to invest. And the conversation about investing is, it can start with literally like 100 Rand. Like I started my investment journey with buying a share for 20 Rand. All those years ago, I didn't even know what I was doing, but I was like, okay, let me just buy. I'm familiar with this company. I know the company, and I just bought the share. And so that's kind of, and then as time went on, I was able to allocate more towards my investing. And as I learned more, I was able to kind of understand more about investing and creating an investment portfolio for myself. But it started there. That was the first step. So even if you are in the position of feeling like, oh, actually, I can't afford to invest right now, that's fine. But maybe think of it as, okay, as right now, I would like to invest X amount of money, but I don't have that money. But what I can do is start teaching myself investing by just investing maybe 50 Rand a month or 100 Rand a month or whatever it is, so that as you build the habit of investing and you're learning about investing, by the time you're in a position of allocating more towards your investment, you've already kind of covered the groundwork. And now by the time you get to that position, you're able to invest more easier, build your portfolio more quicker, and things will just become less intimidating. And so once you've answered these questions, then the conversation of platform comes into place, because essentially you would need to decide, where are you going to put your money? Where are you going to be investing? And so it's important to understand why this is crucial, because it affects a lot of things. It affects the things that you can invest in. It affects your fees that you pay and the type of assets that are available to you, and just kind of finding the right investments that are suited to the type of person that you are and maybe your goals as well. And so the different types of investments. One is an online brokerage account. So these platforms are where you're able to buy and sell a wide range of assets like stocks, ETFs, bonds, mutual funds on your own without needing someone else's assistance or needing a professional, a broker, or an advisor, or someone to do it on your behalf. And a lot of those online brokerages that are famous, that we all know, I'm quite sure, Easy Equities, Satrix now are very popular because of their low fees and ease of use. But this is an example of online brokerage accounts, and they're suited for people who prefer to take control of the investments. So that is where the name that is given to people who do use these platforms are retail investors. So it's people like you and I, individuals. Then there are robo-advisors, kind of automated platforms. So when you go on the platform, it's kind of built, they've got certain steps built in to help manage your investment, and kind of they do the background work for you. So one robo-advisor that I really like is Frank, and I use it. There's also a Signia robo-advisor. And so it's kind of passive investing. They set up their platform in a way that when you download the app, it kind of has questions that it asks you, and it kind of tailors your investment in a certain way. And then it's more of a hands-off approach. And then all you do is just kind of put in money and fund your account. And then there's another way of obviously traditional financial advisors or a financial planner. So this would be someone who would help kind of tailor your financial investment needs and recommending a platform and a strategy. And a lot of the times they would work with either like about Ellen Gray, those type of companies, those like, I forgot what they're called. There's a specific name for those company, Investec, Ellen Gray, those type of platforms. But because of the advice and because you went that route, there's really higher fees attached to that because of tailoring the advice and having someone actively manage or assist you in crafting and coming up with your investment strategy and plan. And then bank investment accounts. So banks do offer investment options. So FNB, Standard Bank, I'm sure all the banks have an investment platform. So where you can go directly to your bank and say, this is what you want. And they've got a wide range of options and investment options available depending on what you want. And some of them might have a minimum investment amount to open that specific investment account or whatever. And then you do it through your bank. So those are the type of different platform types that are available or routes that you can take. My favorites are absolutely the online brokerage account and then the robo-advisor. So that's kind of what I use and my strategy. So I have investments in Easy Equities and I've got investments in Frank. There's also eStash, that's a robo-advisor as well, Stash by Liberty. So those are kind of the ones that I use, mainly because of the low fees, especially in the online brokerage accounts. Low fees, ease of use, and kind of the wide range available to you. Also, another platform is Brockstock. That would also be an online brokerage account. My least favorites would be these two at the bottom because of the fees attached to it. And just kind of how they can eat into the returns that you get. Which is nice that we're now getting into the fees and costs. So it's important to consider this because they can have a big impact in your investment returns over time. We did look at this example as well when we were having the retirement conversation and looking at how fees can impact your overall returns on your retirement. And we did look at an example together. And so it's important to always consider fees and how much is it going to cost you to have that investment in that specific thing or in that platform. And so trading fees, usually these are costs incurred when you buy and sell investments. Some platforms charge per transaction. Some of them kind of charge a flat fee or a commission. So for example, Easy Equities charges relatively very low fees compared to other traditional brokers, and Easy Equities charge fees when you buy. So when you buy maybe a share or an ETF, they'll charge you trading fees, and then they charge you for selling as well. But in the market, they are very competitive at the moment because of their fees, very, very low fees. Satrix now as well has got competitive fees. Management fees, usually that is attached to a robo-advisor or platform where your investments are actively managed. So you'll most likely pay a percentage of your assets under the management of that as an annual fee. So sometimes they would range from 0.5 to 1.5. You kind of need to just be aware of these when you are using a robo-advisor type of platform or a platform that is actively managed on your behalf. And so you need to just kind of know what that looks like and how much percentage are you paying to have your assets managed as an annual fee. Some of them will have platform or subscription fees. So for example, with Easy Equities, they've now introduced, what is it called, Gonje? Easy, what is it? It's the new fee thing of paying 25 Rand a month as like a fee. I forgot the term that they gave for it, which was a fee that they never had before.
So it's Thrive. Is it Thrive or something?
Yeah, it's the Thrive thing, but they call it the Thrive fees. Yeah. So that's a new thing that they've introduced that wasn't there before. And so sometimes there will be that. There are some platforms maybe that will charge a monthly and annual fee to access those services. I know of the platform but they're not an investment platform. FinMeUp. They're not an investment platform, but they're more like an investment educational platform. And I know that they do charge fees for certain subscriptions if you are wanting advice or whatever, or additional services from the free platform, you'd pay kind of platform fees or subscription fees. So, excuse me, it's important to note when you are looking at a platform, do these fees apply? And then hidden costs. It's very important
Miranda,
to know. Yes.
With platforms like Frank and Easy Equities, do you get any form of documentation in an event of death? The investor, what happens? Do you have a beneficiary that you have put up? You know, with like normal insurance companies, you'd have a beneficiary that would go and claim your money because you would have provided them with the necessary documents, and they would know what to submit as supporting documents that they're the actual beneficiaries. What happens in the case, especially with investments that are outside of South Africa,
like international investments,
like S&P 500?
So essentially, I think the process there would be, I'm just trying to think about it now. Once you pass, depending on whether you had a will or not, because if you had a will, all of those investments would form part of your assets under your will and your estate. And then depending on what you had placed on your will, it would go and it would be done in the way that you've specified. But let's say you didn't have a will and you do pass, I assume it would form part of your estate, and then the estate would dictate how those assets are liquidated. So I think they would liquidate your account depending on if your estate is in a, I mean, I stand to be corrected. I could be very, very wrong. But you know, when they wind up your estates and they have to pay off your debts and all of that, if you did have any debts or anything like that, especially if there wasn't anything in place to cover those debts, I think they would liquidify all of that to pay off your debts so that your estate is winded up and closed. So I think that's what would happen. But that is a very good question. I think a will would help kind of dictate what happens to that. So when you know your estate is being winded up, they can see, okay, this is what they've chosen for these type of assets, because it would be part of your assets. But I think that is a good question. I'm not quite sure on the what is this on the is the equity side or Frank side, what is the procedure and process in case someone does pass away? What do they do? I think that is a really good question. Let's see.
All right.
So isn't it when you register an estate, what's it called? Your legal entity, whatever, posts or communicates to every financial institution, I guess, registered within SA. I think they may transfer the shares if you want to transfer the shares if someone else, I think, what's it called? The beneficiaries have an active account or otherwise, then they, whatever value they were at that time, then they would maybe sell them or whatever and then transfer that money into the estate account.
Yeah, I think there would be that process. I'm just looking here on Easy Equity. So they have this question. We have an estate leave process that occurs once an account has died. It's imperative that you have outlined your wishes and funds holding in your will. So yeah, I think it's important to have a will for this type of process. But even if you don't have a will, I think the similar process might be the case. So a family member or your estate executor would then submit on your behalf some of these documents that they need. And then you, as the person who holds the account, you would need to, so if you wish the portfolio to be transferred to a beneficiary, you will then require a will, and then you would need to sign a beneficial form. So there it is.
Okay, thank you.
So you need to have a will. It's really important for these type of things, because if you don't have a will, what would happen is that the state would kind of handle your affairs, and maybe they would need you to apply for an executor, so maybe a family member or whatever, depending on the situation, and then that person would be the one kind of going through this process and sorting it out. But having a will just makes things so much easier, I think.
So I think if you don't have a will, then if you are married, then your partner will be the executor. unless
Yes.
you guys decide. But usually what will happen then, I guess for women it's simpler because you can sort of say these are my children, and we know South African men or men in general, with different children in other cities. Then what they'll do is they would advertise. I'm not sure if it's in a newspaper or what.
The
I think to
Gazette, the government Gazette.
Yeah, the government gazette for a period of 30 days, if I'm not mistaken. And then
Okay.
if no other family member or child of the supposed male doesn't come through, then they move forward with whichever children that are
Are
available. So
registered.
then if it's 3 children that are registered and maybe the wife is the executor, then the wife in this case, if married in community of property, will get the 50%, and then the children will share the remaining 50%.
Okay. I know with my brother-in-law, when he passed last year, because he didn't have a will, he has a child. So obviously the child is registered in the unabridged certificate. When they did it, he is registered as the father. So on the system, she came up as his beneficiary essentially, and so everything went to her. But because of her mom as her current guardian, it went to the mother. So everything went to her because she was his only registered child, obviously at the time, and so everything is now going to her, and the whole process is her because she's the guardian. So it can help it also happen in that case where if the guy wasn't married and he has children registered and a baby mama, it would go to the guardians of the child.
Yeah, ideally, then they might also put it in a trust, in a trust
Yes.
account. So then, until the child is old enough, or maybe a portion of it, to say, or this child may still need education money or whatever. But yeah, there's a whole, it's quite a process.
Yeah, it's a draining process, Shima, won't lie. Yeah, that's why it's better to just have a will, bruh. Have a will, guys. Have a will. It's Wills Month. And so a lot of institutions are doing wills for free. I know we're not talking about a totally different conversation, but yeah, it's important to have a will, I think. So, Nkuli, does that answer your question?
Yes, I am answered.
Okay.
Thank you.
Coolies. And then there are investment options available. We'll look at these in depth as we go down. I'm not going to look at them now. User experience and ease of use, especially if you're a beginner, it's really important. I find a lot of beginners get overwhelmed by easy equities, and I get it. I get why, because there's just so much on there. There's easy equity. There's the easy equity ZAR account. There's the easy equities TFSA. There's easy property. That there's just quite a lot of things, and so it can become very, very overwhelming really quickly. And sometimes I always say maybe go the robo-advisor route, like a Frank, for example, which is a very straightforward, easy system to kind of navigate and understand. But then you need to obviously factor in and consider the costs and kind of weigh those. But for ease of use and just kind of hands-off approach, robo-advisors are essentially better, I think, for beginners, especially if they do feel overwhelmed by online brokerages like Easy Equities that offer like a lot of products. And so ease of use, mobile access, minimum investment requirements is also really important to note. Some platforms require minimum investment account like banks. So if you go to a bank, some banks will require maybe for a certain investment account, you need to have minimum 500 Rand, 1,000, 5,000, depends on the account. Whereas some just allow you to invest with as little as 100 Rand or less. So platforms like Easy Equities, Frank, allow you to invest with very low amounts, making it really easy for beginners who have smaller budgets to kind of get into it. And then some platforms have higher minimums, so it's just important to find one that fits your budget and can be suitable to what you're looking for. This one I think is important, and also this one, customer support and reputation. Today I came across someone's post about a company that does PPS, like a professional service company for retirement and death benefits and all of that. And they were obviously sharing and complaining about the experience that they've had. and just kind of the reputation, and sharing how many people are in the same position as she is, and just so many reviews, bad reviews posted on about that platform, for example. And so I was like having a bit of a conversation on my Instagram stories, just talking around this and how important it is to, I mean, it's sometimes it is a hit or miss, essentially, when it comes to this, because one person can have an amazing experience with the platform and another person can have like a terrible experience. For me, for example, with eStash, the Liberty app, I use Stash. I've been able to withdraw from Stash. I've never had an issue. But whenever I talk about Stash, for example, on my TikTok, or mainly on my TikTok, I have had quite mixed reviews where people are struggling to withdraw, they're struggling to get through to them. And so that's why I hardly talk about Stash anymore on my platforms, and also because I don't use it as much as I do like now. But it's kind of those situations where you need to consider, okay, like if I have an issue, will I be able to get customer support and help? Does this company have a good reputation? Am I going to be able to withdraw my money? You know, and yes, it's difficult to know what would happen to you, because maybe that's just that person's maybe bad luck and experience. But if there are an overwhelming amount of bad reviews, then maybe you do need to be like, okay, maybe there is an issue with this company, and I need to kind of run away from it. Because it's one thing to find a platform that's great, that will give you the great returns, but it's another thing if you're going to be coming up with issues. If there's a problem with your account, you need to withdraw, you can't withdraw, and you're not getting help. I think it just makes the whole experience sour, and it can become very disappointing and overwhelming really quickly if you are in that position. And so I think this is really important, to do as much research as possible around that. And yes, every person's experience is different, but I think when you are doing your research on platforms, just kind of see the common themes and the common sort of issues that people are talking about. So for me, I started picking up that Stash. People are complaining about not being able to withdraw on Stash, and it's just not one person, it's different people over a period of time. So I was like noticing that that situation and being like, okay, there seems maybe to be a problem in the process when it comes to people withdrawing, you know. So it's kind of those things that you need to really be aware of, because it can sour your experience really quickly, and it can be very frustrating, especially when you need your money and you're not getting help. It just kind of makes everything really, really frustrating. Then over and above that, I think this part about regulatory and security oversight, and just being aware of, are they compliant? It goes to the question of amabanoi, pyramid schemes, or those like invest now, get 40% return in a week or 2 weeks, and then people getting scammed, and then that thing not coming back with their money, and then people crying on social media saying, I invested this in this company and this happened, kind of thing. And so what I always say is that you need to check if that company is registered with the FSCA. Do they have a license to operate? Because for them to be an investment platform, they need to be regulated and licensed, and kind of go under strict financial regulations. Yes.
How do I verify that?
You go on FSCA. So you go on the FSCA website, you would then do an FSP search. So regulated entities. Oh, my network. Let's see. Where is the one where you search? Oh, there we go. So FSP search, you go on here and then you would search. I know Easy Equities doesn't go by Easy Equities. It goes by Trade World something. Let's see if we can find it using Easy Equities. I know their holding company name is Trade World something.
Okay, so you search them by their name.
Yeah, you'd search them by name. I just want to see if this is going to pop up. FSP name. Yeah, First World Trader, sorry. So there we go. There's Easy Equities, First World Trader, trading as Easy Equities. There's a FSP license. it's authorized, and so you can like get more details on the company. You can find out like where to contact them, compliance officers, the people that are registered key individuals, kind of the okay, and all of that. So you'd find that information on there. If the company is not on here and it's an investment company, do not invest.
So this is for South African companies, I'm assuming,
yes.
or is it?
Yes, South African.
So if it were to be another country, I'd have to find out what is their own version of this.
Yeah.
Okay.
But yeah, it's really important, because then if anything were to happen with that specific company, you can then go to the FSCA and report that company to the FSCA if there's maybe some trade happening or whatever it is. There's just a bit more surety and support or security around that. Whereas if it's not registered, I mean, they're not compliant to anything. They can do whatever. They are not regulated by certain rules. They haven't structured their products in a way that is in accordance to FSCA, because FSCA also has to consider kind of Consumer Protection Acts and kind of look into how does that company do its dealings. Are they returns relative to that specific asset class, or are they giving, like, there's certain measures and things that are in place. And so if something is saying a 40% return in 2 weeks, that would raise alarm bells for me, because that is outside of the FSCA guidelines in terms of how certain asset classes perform. So I know with crypto, I mean, it's a bit different, but it falls in line with that. So you need to just vet and check companies. So it's really important to do this process, especially if it's a new company you've never heard of before and you're considering investing with them. Just double check that they are registered with the FSCA, and then just make sure that the platform has security measures in place, especially for an app. So is there a way for them to verify that you are the person that is using that app or that account? Just for fraud protection, I have heard instances of like fraud protection on some accounts, not with Easy Equities. I forgot what the investment platform was, but it was like a whole thing on Twitter a few years ago. And so that's why it's important to just make sure that platform prioritizes security.
I become nervous with those platforms, especially like online platforms. I don't know. I'm just so traditional that I want to see a bank branch or a branch that I can walk into and have someone help. Anything that is like online or like Discovery Bank, I'm just like, oh my goodness, who's going to be there to help me in
something goes wrong?
That's what I ended up investing with, just banks.
Yeah,
almost all banks in South Africa, but all my money is with just the banks, because I'm scared of platforms. Like with Easy Equities, I tried to navigate it by myself. I got nervous along the way. I become very nervous when it comes to these things, because I'm just like, if it closes tomorrow, who do I talk to?
No, I feel you. I get your concern, and it's a very valid concern, because for you, it's like walking to a bank. You can see, feel, touch the bank. You know where the branch is. You know where to go to. But with Easy Equities, they do have offices in Joburg, I think, and they do have physical offices. But I mean, no one's going to walk up to Easy Equities physical offices, and I think it's just where the workers and the people that work there go and are. But essentially, you would go through the FSCA process if anything were to have happened, because then they would need to be held accountable by the FSCA, because they are governed by it. So I think then there would be, I mean, I don't know what the process would be because it hasn't happened, but I think maybe there would be something that would happen where if you have invested in this company and it was registered and something happens, some surety from the process or from FSCA side would come from there. I'm not sure. And I think maybe I should do some research on that just to see what the process would be if Easy Equities maybe were to be shut down. Like, what happens to my money? What happens to my account? But even with the banks as well, I think there's that 100,000 rand surety, and then anything above that is like, okay, you're on your own. So there is a risk that it exists on both sides. But I get with the bank side, it's almost like, okay, I know for sure that there's that bank insurance and surety. I know I can go to a physical branch. And then it's kind of like, okay, I just can stomach the extra costs that come with going with the bank because of the higher fees and maybe limitation on what they offer. Because I find that banks' investment accounts or investment portfolios or accounts or things that they offer are very limited in terms of diversification and variety. Whereas with these online platforms, they are a bit more innovative in offering different types of products in the market. So it just really depends on you, and it makes sense like why you would feel that way and why you would feel like, no, this is very scary. Like, I'm so scared, because I think as a country, we have seen a lot of these online situations or unregistered companies come and go, and people lose their money and it becomes a whole thing, and things trend for like a long time. But I think also it goes back to the checking of, reputation, read the reputation, user feedback. Is it registered? What is people's experience of this company? If they had an issue, what was the process of sorting out that issue? And it kind of goes into that research that you would need to do before choosing the platform to be like, okay, you kind of have satisfied all your questions, and now you can make an informed decision to kind of take away that fear, which I think is good to have in place, because then that means you are making sound decisions.
All right. No, thank you. Because even with the other countries, I was approached by some company that sold me the idea of, if I want to invest in property, does it really make sense to invest in property in South Africa? Because I mean, with the value of rand going down slowly, and wouldn't it be advisable to invest in like first world countries and countries with exponential growth like Singapore? I was sold with that idea, but immediately went into that mode of fear, and I'm just like, okay, but the nice thing about South Africa is that there are doors that I can walk into, and I know what the regulations are around that. Even though there's a big chance of me losing a lot of money because I'm only insured for 100K with each bank. But with those countries, okay, if anything happens in America, if the president gets short, and then like the value of that currency goes down anyway, or whatever changes happen, who do I talk to? How am I protected? What are the laws and the rules around investors or protection of people's investments in that country?
Yeah, I think those are great questions, and it's good that you are asking those questions. Then the due diligence is on you to answer them. Either ask the companies, that are contacting you, all of those questions, and make sure that you're satisfied. Then, kind of do your own, assessment. But also, I think it kind of falls into this part of risk tolerance and risk assessment. You kind of, look into your own risk appetite and determine for yourself, okay, I'm not a risk. I'm very risk sensitive. So I need to kind of find things that will kind of alleviate that stress when it comes to riskier things. And also there's the notion of balancing out your investment portfolio and making sure that it's diversified in a sense where you are allocating. So for example, if your portfolio is this basket and you are like, okay, you want to kind of start investing in more riskier things, but you don't want all your money to be in that basket, then kind of diversify your portfolio and your money into something that's less riskier, something that, you feel more comfortable in, and then just have a little bit of exposure of the risks. For example, for me, my portfolio, I like to invest in crypto. It's more volatile, it's more riskier, but only a small percentage of my portfolio is in crypto. The majority of my portfolio is in something else. And that's kind of how I balance it out. And then my focus is, or how I allocate money into my investments is, okay, I kind of go through a hierarchy of, okay, this is what I want to focus in. My method and focus is TFSA, ETFs. Once I've maxed out my ETFs, let's move on to the next thing. And that's kind of the hierarchy that I go in investment. So sometimes a year will go without me buying anything in crypto because I've been focusing on the funnel, kind of. This is how I want my investment portfolio to be structured, and this is how I want to diversify it. And so you can manage the risk as well in that. making sure that, okay, if I am investing in this thing that's riskier, if it represents 10% of my portfolio, how do I feel? Is that too risky? Let me reduce the contribution to like only 5% of my portfolio. Then that's a bit better to manage, because then 95 of the rest of the portfolio is in something that's less riskier and something that kind of helps you manage your risk.
Hello.
Thank you. Because it's the risk management thing for me. It riles me up so badly.
Yeah, but we will look at how to manage your risk and how to build like your portfolio in a way and have contributions in a way that you can always keep track of it. And this is going to be in the template that I'm going to share with you guys. And you can always keep track of it. Okay, am I happy with the contributions? Am I happy in holding so much percentage in this specific thing that is higher risk? And it's good to track because then you have a visual representation of, oh, it's only 2%. It's fine. Like, it's not a lot of money. Whereas if you don't have that tracking system, it's very difficult for you to know. Maybe for you, 10,000 Rand feels like a lot of money, but when you look at it in the entirety of your portfolio, it's only like 2% or it's only like 1%. Then it's like, okay, it's not a lot.
Yeah. Okay, thank you.
Can I answer Nonkululeko?
Yes.
One thing about these people, scammers or criminals, they are very smart. So what they'll do to take away the fear, they open branches all over. And for people like us who are not well informed or educated, we trust them and they're so manipulative. So we end up investing. You think that it's legit and you make money just to find out that you're not. One day you go there and you find out that they're nowhere to be found all over. And they don't just open branches in one city, it's all over. So yeah.
Yeah. So it's like they're building credibility.
They do. And
I saw another
scam. Hard to get in and invest, whatever. So they ask for a lot of things and things that are difficult to find. So now you think it's legit, but it's not. You would need a lot of documents for you just to invest.
Exactly. I saw another scam.
Verification, they make it hard. So you think this is legit, and it's not. These people are so smart.
It's not. They're liars. I saw another scam advertising at the airport, and the people that were in the scam were like, yes, it's credited. Look, it's all over the billboards and at the airport. But I'm like, I can walk up to the airport and say, hey, I want to put up my billboard. And they can say, we charge this amount of money, and I can put up my billboard there. It doesn't build credibility, but because they were buying billboards all over and putting billboards and advertising at the airport. They were able to lure people into thinking it's legit because of that. And it was just so interesting to see how gullible and easily influenced and easily like manipulated people are. Because by advertising at the airport, it must be legit. That's not true. It's just they had the budget to advertise at the airport. You can also go and inquire to advertise your business at the airport. As long as you're willing to pay the price, they're happy to make the business. And so those are like Lentisho Londi. They have those little things that they want to tick boxes so that they make you feel secure with, okay, at least because of these things, they are secure, legit, but they actually just not. And so the best ways to check is to go through and do the authorization on FSCA. Sometimes you can even email FSCA directly to inquire about a company. Be like, hey, so this company, send them maybe the company websites. I've seen instances, and then FSCA will either release a report or feedback to say, no, we don't know this company, it's not registered with us, to alert the public about that specific company because it is operating illegally, or they're not following the FSCA guidelines of how to structure an investment and all of that. So, yeah.
Okay. Thank you so much. Yeah.
No problems.
Because I'm just like, oh my gosh. I'm not willing to lose any of this.
Yeah, no, it's good. It's good that you are thinking that way. It shows that you care about your money and you care about where your money goes. But maybe also just don't allow your fear to overrule, to stop you from kind of taking your investment journey to the next level and tapping into other things that maybe would accelerate your investment process and growth, especially if you have a keen interest in those things. It's just really good to manage your risk. Make sure you're managing your risk. Make sure you're putting in money that you would be happy to lose in the beginning as you test it out. And obviously ensure that those companies are registered and, do your due diligence on all of those things. But yeah, just manage your risk and then see where it goes and kind of learn through the process as you do that. But it is good that you do have those fears, because then it means that whenever you make the decision, it's going to be a sound decision, and it's going to be a decision that you have thought through thoroughly and you've kind of researched and all of that. But yeah, maybe sometimes it can happen that your fear can stop you from taking that leap of faith, but within reason. Don't just take the leap of faith on anything. It's important to consider what are the things that you are going into and testing out. But I'm a risk taker, so don't take my word for it. Yeah, I don't have an issue with putting things in risk things, but even with that, I still very much manage my risk. I still very much put in measures in place to help protect myself against myself, because I know myself. And so it's also going to be that type of process for you as well, to just make sure that you are only testing the waters in something that you are comfortable in doing and with amounts that you are happy to do to test.
Yeah, no, definitely.
Yeah. And so this part is about starting small, how to invest with limited funds. As I mentioned, I made my first share or investment purchase with just 20 Rand. And I like to talk a lot about investing with as little as 100 Rand or less on socials. It's just kind of become my tagline. And, it's very easy to start there. But what I like about the small beginnings is that over time, because it's like less small money, you are able to kind of, okay, you know what, let me test this, let me test that. There's less financial pressure. You are learning without fear, because depending on obviously where you are and how much of a difference 100 Rand would make in your life, relatively, if someone were to lose 100 Rand in an investment, it might feel very differently to someone losing 100,000 Rand, for example. I know the two comparisons are quite far off, but it's kind of that notion of building a little by little over time. And then once you become comfortable and have more access and more funds, you are then able to put in your money more where you are seeing the returns and in something that you are comfortable with. And so I like starting small and building that habit over time with anything that you have. And so some platforms that accommodate this, Easy Equities, Frank, Stocks for Fells, and group investments. Some banks do offer group investments or joint Stokvel investment clubs where you can tailor kind of structure. I know Frank does this as well, where they call it shared saving goals or shared goals. It's almost run like a Stokvel type of, but it is an investment type of account, and you can start with as little as 50 Rand, 100 Rand, even less than that. And so this portion of Easy Equities allowing you to start with these little amounts is called fractional shares or buying fractional shares. And what this means is that, for example, if a share is worth 100 Rand, so to own one full share, it's 100 Rand, but you only have 50 Rand, that would mean that you can buy the 50 Rand, but it would be a fractional share. So it would only be half the share. And you'd still own half the share, but you wouldn't own a full share as if you had bought 100 Rand. And so that's the nice thing about it, is that you don't need to wait until you have enough money to buy full shares. You can buy part shares or fractional shares. Sorry. And so strategies for small investors. I love tax-free savings accounts, or the structure of tax-free savings account. And there is a lesson plan focused on just that. But what a tax-free savings account is, the name sounds it's like almost like misleading, because it's not essentially that. But what a tax-free savings account is that the government wants to incentivize people for investing and saving. And so what they've said is that they will allow you to invest in a tax-free savings account and put in money up to 36,000 Rand a year. And then over your lifetime, up to 500,000. And so if you were to invest 36,000 each year to meet obviously the limitations of the tax-free savings account, it will take you about 13 years to reach this, 13 years and 8 months to reach this 500,000 limit. But what's nice about a tax-free savings account is that you don't pay any taxes on any return, provided that you stick within the contribution guidelines. And so that's why I think this is such a powerful tool for beginners to grow their investments and to start investing tax-free. And so tax-free savings account is the account name, but then what you invest in it and what you put in it then is the different asset classes, and that's kind of determined by where you open your account. So maybe you might open a tax-free savings account at a bank and it will be kind of an investment account. But if you have one with maybe Easy Equities, for example, my tax-free savings account, I invest in ETFs in my Easy Equities account. And so that's kind of how I invest in my TFSA. And so my strategy or way in which I invest starts at tax-free savings account, max out my tax-free savings account by buying ETFs. So invest 36,000 Rand a year in my tax-free savings account. I don't look, I don't see, I don't think about anything else but until I've achieved this, or until this is like my plan. And even in that, in the ETFs that I invest in, I am trying not to over diversify. So in the beginning, I used to like buy different ETFs each month. Now I'm only focusing on maybe 3 or 4 ETFs, depending on how much money I have to invest. But within my portfolio, I'm only trying to hold 3 or 4 ETFs maximum that focus on different industries, and that's it. And so if I have 1,000 Rand to invest, maybe I'm going to just pick 2, 500 here, and kind of leave it at that and go about my day. If I have 4,000, then maybe I'll put 1,000 in these 4 and go about my day. And that is it. There's no need to complicate things. I'm not buying individual shares. I'm not looking at any of that stuff. I'm focusing on a tax-free savings account, buying ETFs, and that is it.
Okay, Miranda. I don't know if you've just mentioned something about buying individual shares, because sometimes I used to get overwhelmed by like my favorite financial bunnies and stuff on YouTube when they speak about the things that can affect the share and the interest that you make. Now it sounds like I have to be tapped in on what is happening around the world to know what is going to happen to my funds. Is there a way that I can just put in money, forget about it, the same way that I do with the bank? Because I never know, the grounds that make the bank give me whatever returns that they give me, even though they're minimal, but it takes away like the pressure of me worrying about what's going to happen. I just wait for the time that I will see what happens with my returns. But now when it starts to sound like I have to read up and be clued up whether I want to invest in Sasol or whether I want to invest in Unilever, which company is doing well at what time, are they changing CEOs? I'm like, oh no, I don't know if I have time for that. I don't know if I'll have time for that, honestly. So I just want my money to work for me without worrying too much about where exactly is it going, and how am I making money?
You asked that because I also felt that way when I started. I was like, okay, I've bought this 20 Rand share in, I think, MTN or Telkom it was. And then I was like, okay, where to from here? Like, there's so many other companies. Which one should I buy next? And I just kind of focused on my Zara account, and I was just, okay, I'm going to buy companies that I know. So I bought Mr. Price. I bought like companies that I was using and that I knew. But I was not doing any analysis at that point. I just was buying. But then I was like, okay, I'm seeing this person talk about this company and this company is paying out dividends. So do I need to, and I was just like, no, this is just too overwhelming. And over time, I decided this is going to be my system and how I do things. Block the outside noise, invest in ETFs. ETFs are basket of shares. So for example, so ETFs is a basket of shares that tracks a similar index. For example, the South African top 40 ETF, it tracks the top 40 companies in South Africa. So when you buy that ETF, you are buying essentially a share in those top 40 companies. And for me, it's diversified because I'm not buying just the single Sasol, where if Sasol's down, I feel it heavily on my portfolio, depending on how much I own of Sasol. For me, it's like diluted type of performance, because if Sasol's in this basket, if Sasol's up, something else is going to be down, something else is going to be up, and the overall effect on my investment of the basket is going to look very different if I owned the basket of 40 shares as opposed to just owning the one share. Two, ETF takes away the guessing work for me, or the thinking work as a beginner. I don't even know, especially when I was in the beginning. Yes, I do have an accounting background. For me, it was easier to understand a graph. I was able to read company financials because of my accounting background. But for someone who doesn't have that, they wouldn't know where to start. They wouldn't know what to look at. Like, let's say top 40 ETF. What is the name for it?
Centrix.
So this is how the top 40 is kind of spit out, right? So there's like percentages in this. So as you buy the top 40, you're not buying an equal share of all these companies. It's like kind of spit out. And but like, for example, for someone who's looking at this, they don't, who doesn't have an experience of understanding what this is, they look at this and they're like, I have no idea. Like, I don't know what I'm looking at. Where am I supposed to look? And so, especially if it was an individual share, it's like, okay, people are always like buy low, sell high, but you don't know where the low is. Like, where's the best low? What is the right low? What is the right high? And so it just gets very confusing very quickly. And that's why I like ETFs. It takes away that work for me. The fund is already built in. It's already created. There it is. I'm buying a stake in each of these industries and each of these companies in the top 40 companies. That's all I need to do. I'm buying this company, and because I want to own that ETF for a long time, I buy whether it's up, whether it's down, and that goes into the next point of dollar cost averaging or rand cost averaging. And it's just, that's what I do. With individual shares, it can get really confusing and overwhelming really quickly, because then there's the whole thing of, I'm going to time the market, I'm going to wait until it's down, I'm going to wait till it's up. Essentially, you need to kind of know what is happening with what you have invested in, but not having that in-depth knowledge as you would if you were tracking an individual share. For example, with the S&P 500, for example, earlier this year in March, it reached the highest of the highs in history, and that was nice to know about it. But that didn't change, wait, let me go year to date. So it was in March. Notice year to date. It was sometime here where it reached like the highest highs that it's ever reached in history. Yes. Yeah. And so, I mean, if you look at the performance over time, it's been gradually growing, and then it dropped in COVID on March 6th. It really dropped, and then it kind of recovered, and then it dropped. And then there was a time, I think it was sometime in March, where it reached one of the highest highs it's ever reached in its history of existence. But there's no way for you to know when that high is coming, right? Yeah. There's no way for you to measure and know, it's okay, now I need to buy at this time. And so the strategy here is to rand cost average. Buy shares regardless of the market conditions, or regularly, buy today, if you are buying it consistently, or buy it quarterly, depending on how you want to do things. But then once you've bought it, forget about it. If it's part of your long-term strategy. But with individual shares, Sana, you are gonna be pulled in all directions, especially if you're gonna be trying to follow what people are doing. I'm part of this Easy Equities Facebook group, and every day someone is posting a new share. Imagine if every time someone posted a share, I was jumping and I was like, do I need to buy? For me, it's like nice to be on the group because I can see what people are investing in, conversations around investing, but also it's my job to know those type of things and to know those type of conversations. You don't need to be in those groups. All you need to do is to be like, okay, I'm overwhelmed by investing. I need to come up with an easy, simple way to help me invest. Right, tax-free savings account. I would advise everyone to start there as a starting point to take advantage of the tax benefit. Right, cool. I only have 36,000 Rand to invest in a year in my tax-free savings account. What am I going to invest in? Next thing, ETFs. They already kind of put together. So there's different ETFs you can buy for different markets. So there's a S&P 500. S&P 500 measures the top 500 performing companies in America. Great. It's an international investment. So you've diversified into a global market. Let me buy the top 40 performing companies. Great. That's your second ETF. Maybe your third ETF is maybe I want to have exposure to the Japan market. So I'll buy an MSCI Japan or whatever it is. And then maybe I want to own an ETF in retail bonds or retail savings bonds or bonds. Then maybe those are your 4 ETFs. Then all you do is every month, you just either, depending on how much money you have, if you're investing 1,000 Rand, maybe you can split 500 between 2 or 250 across the 4, however you want to do it, and then go live your life.
Sounds like a grand plan. I like that.
It's simple. You don't need to overcome, and then just block the outside noise.
It sounds really simple because I just get so frustrated that I'm like, I don't know if it's the language, the jargon, and I'm like, I'm getting lost in all of this.
Yeah.
But yeah, you've made it so simple. With the tax-free account, tax-free savings account. So even if you put up 36,000, like as a once-off thing for the whole year, I mean, you can't put in more than that, right?
No.
So it means for 30.
Sorry, you can. So with the tax-free saving account, the limit is for tax purposes. SARS is saying, I'm not going to tax you on anything you get as a return up to 36,000. So the technicality of it, I can invest more, but then I'll be taxed on the more. Anything above 36,000 Rand, I'm going to get taxed on it. And the tax implications are quite high. I think the percentage is around 40%. The return you get on that extra that you've invested in will be taxed at a high rate. So that's why we almost make it seem like that's the rule. 36,000 is all you can invest because the implications of going over are quite big.
Okay, I get it.
Does it make sense? So you can invest more. I'm not saying you, almost like the tax implications have made it the rule that you can only invest up to 36,000.
I see. And then they say it gets maxed at 500,000. So that's when you stop. You can't put in any Rand extra.
Right. Which will take you about 13 years, 8 months to accomplish anyway. So that is quite a while.
Is there a percentage, with like investment, like it's at 8%, 9%? Is there a percentage? Because after 500K, what am I getting maybe in the next 20 years?
So I think it depends on what you've invested in and how whatever's in your tax-free savings account, what is the mix attached to that? What does that look like?
Okay.
And then you just kind of keep compound return based on what is made up in your tax-free savings account.
Okay.
Yeah. So a lot of the times the tax-free savings account conversation is like, don't withdraw from it, because if you withdraw from your tax-free savings account, you can't replace withdrawal. So once you've contributed 36,000, you can't say, okay, I'm going to take out 4,000 and then I can pay back, because then you'd go over.
Yeah.
So it's like, okay, you need to think about it as a long-term plan. And so a lot of people are substituting their retirement account. So they have like their retirement, maybe from work, pension fund, retirement annuity, but then they have a tax-free savings account as like an additional retirement plan for long-term.
Do I go to a bank for the tax-free savings account?
You can go to a bank. You can do it on Easy. Frank isn't tax-free, so I've been bugging them to make their platform or their options tax-free. I think it will be such a game changer for them. But yes, banks do have tax-free, and then investment companies like Allan Gray or Alexander Forbes. I don't know if they do investments. Allan Gray, I know they do have a tax-free investment option. So yeah, different financial institutions do have tax-free investments or some type of tax-free investment, but you just need to double check what is in that tax-free.
So then I can compare like which one sounds more appealing to me. Okay.
Yeah.
All right. Thank you so much.
Cool. But that's the strategy. You don't need to complicate it by looking at individual shares as a new investor. it gets overwhelming really quickly, especially with the time where we live and where everyone's sharing information. And I think it's great that people are talking about investing and sharing what they've invested in and all of that. But for me, I engage in that because it's my job. But for you as a, especially as a beginner, block the outside noise. What is important then, once you've selected, okay, I'm going to be investing in these things, you don't need to know in depth, but it's important to kind of know what is happening with your investments. So kind of get clued up. If you see something that's happening, maybe people are sharing, this is happening with this company or whatever it is, just be clued up and kind of know and be aware of how that could implicate your investments. Because essentially, when we are investing in these things for long term, we're not saying we're not going to invest about it and never look at it again, or whatever the situation is. Things can change in the future, which how you make decisions about those things. Sometimes you might need to be like, okay, this is now becoming more riskier. I need to reduce my contribution and maybe just look at it and see, and maybe I need to put my money onto this specific thing rather, or whatever it is, and adjust as time goes. Or maybe you might see, okay, with this investment, I'm seeing things in the news or people are saying this about this. I don't feel comfortable holding it. Let me sell and maybe buy something else. So it's just to kind of make those decisions, but with the long-term mindset and thinking in place, because we don't want to just invest and close our eyes. How is our investment performing? What is happening in the news that can affect my investments, because it is your money at the end of the day. And with investing, it takes a level of education. It takes a level of, it's that one extra, because there's so much you can do with budgeting. There's different budget methods available. So much you can do with budgeting. Budgeting is kind of like, okay, I've now built a budgeting system. I'm consistent with my budget, but that's as far as I can go. What more are you going to do? There's so much you can do with paying off debt. Once your debt is paid off, you can make it the decision of staying debt-free forever, or, choosing the type of things you get into debt. So that's your ceiling, like the limit. With saving, it's kind of like, okay, I've built a 3-month emergency fund or a 6-month emergency fund. I'm saving for specific things in my life. But there's like, okay, that's kind of, but with investing, there's just so much that happens, right? There's so much potential. There's so many things to invest. The world is ever changing. Different things are happening that affect your investments at different times. COVID came and affected our investments. And, so with investing, it's an ever going type of conversation. It's never a once off, I'm done. There's no ceiling, I believe. And so it requires some type of investment on your part, to be aware of what you've invested in, to know what's happening with your investments, and to help you make certain decisions about your investments. It is your money at the end of the day, and I think it would be irresponsible to not put in a little effort into knowing about your investments, if that makes sense.
Yeah, it definitely does.
Yeah.
It definitely. Thank you so much. Oh, one more thing.
Yeah.
With banks, they give us the notion that whatever happens, they would never get to a point where you start losing your initial investment amount. Is it the same with these other platforms like Frank and Easy Equities? Is your principal amount protected in a way, or is it possible to lose it?
Yeah. So with that, it is possible to lose it. So this way, let's say you go buy a share in MTN for 100 Rand. And you buy the share in MTN, you own MTN, you get dividends over time, and maybe in like, let's use Vodacom, perfect example. Vodacom, you bought the share in Vodacom, Vodacom's doing really well. And then now Vodacom, this guy, please call me, has won the court case, and they have to pay billions back or whatever it is. And so they have to find the money, right, to pay this guy. Yeah. And you bought your share for 100 Rand 10 years ago, and now it's worth 500 Rand, for example. So it's grown in value over time, and you've been getting dividends each year, and you're happy with your return. And now, the court is like, okay, Vodacom, you need to pay this guy his money. And now they need to kind of make a plan of paying this money. So they'll either liquidate some of the assets, they'll do certain things, and that will affect their share price. And so let's say that action or whatever reduces the share price by a lot, and maybe they need to liquidate and close because the company is not even worth those many billions, and they go into bankruptcy or whatever it is. And from 500 Rand, the share price drops to maybe 20 Rand, less than what you bought it for. So you make a loss. Yes. So there is that possibility that exists with those type of returns. But then also the reward, or the flip side of the reward, is that a lot of the times it doesn't happen as often as you would think. It's always one of those shocking situations where a company does get to that situation, and it would either be declared a bankrupt or whatever. A lot of the times, if a company does go into that, you'd get like rands, or some people say dollars to the cent. You'd get something for your return, for your share, and maybe it would be written off. But you wouldn't get your full investment back. So you would essentially lose your money, or your investment, your initial capital, based on that situation. But it's not something that's going to happen every year.
Okay.
But the risk is there. The risk does exist that there would be the case if that happened. And so that's why it's high risk, high reward when it comes to investing, especially in stocks and shares.
Yeah. All right. I think I'm answered. Yeah. This is fulfilling. Yeah.
I'm happy. I'm glad you have all the questions. That's what I'm here for.
Yeah.
Okay, so choosing your investment type. I know we're a little bit over time. We'll just go through this really quickly. So there's stocks and equities. Stocks, shares is the same thing, which is a stake in a company's performance. So you benefit if the company grows, or the company stock price increases. So for example, with the MTN example, if you bought it for 100 Rand, now it's worth 500 Rand, your share, you've received capital appreciation. If they pay out dividends, every year based on the amount of shares you own, you would get a return with that. So that is kind of that. And the risk and reward there is obviously it's a more high risk, as I've explained in that Vodacom example, because prices can be volatile in the short term. And many things can happen around that, that can affect the company's performance and all of that. Bonds are loans that you give to the government or corporations or like companies in exchange for regular interest payments over a fixed period. Once your bond matures, you get an initial investment back with your return. And so bonds are generally considered lower risk. Some would say medium to low risk, depending on the type of way that you bought your bond. Government bonds, such as those from the South African government, tend to be the safest, which I know sounds very like, what, South African government investing and it being safe. But yeah, with government bonds, there is the guaranteed notion of your return. And then corporate bonds carry more risk, but also have a higher potential return. Bonds offer steady, predictable income over time, and they typically have lower returns compared to stocks because of this reason. So the one is a RSA retail bond by the South African government. That is one of my favorite investment options. We did look at this, I think, last week. And so the South African, why I like it is that it's currently offering really favorable or great interest rates or return. So there's this one where it's the fixed rate. You can fix it for 2 years, get that return, 3 years, get that. And obviously the longer you fix it, the more interest you get. Then there are inflation linked rates. Obviously those are a bit lower. And so you can choose, if you just look at the products, you can choose whether you're gonna do a fixed rate, but then are you gonna do a flat rate, or you're gonna reinvest at the end of the term, so continue your term. But yeah, so those are the government retail savings bonds. I really like them. They're great. You can also buy a ETF of bonds, which is also great to look at. But then there are corporate bonds, like companies for like Eskom or Anglo American. ETFs, my absolute faves, like till death, I will preach ETFs. And as I mentioned, it is a basket of shares tracking a specific index. So, for example, the Sastrix 40 ETF tracks the top 40 JSE listed companies. The MSCI World Index ETF tracks the global stocks. And so this is great for anyone looking for diversification, but also as a beginner, because it takes away that whole like thinking, guessing type of thing, looking at an individual stock, analyzing the graph, checking when to entry point. Like, it just takes away all of that, and it just has better security, I feel. Yeah. Unit trusts. So unit trusts is a pool of money from multiple investors in a variety of assets or like bonds, stocks, property, and they're managed by a professional asset manager. And so there's a risk, depends on how that asset allocation has been done in the unit trust. Some of them may focus on a higher risk equity, some of them might be conservative, some of them might be low risk. It just kind of depends. And so the benefits there's obviously there's someone who's a professional who is managing this and kind of deciding the allocation between this. Allan Gray, I know, is the company that has equity fund, but other companies do have as well, Coronation and all of that. They tend to have higher fees because of an actual, professional managing that. So it's important to note about unit trusts. Real estate property is also great in investing in that. You can also invest in REITs, which is real estate investment trusts, which allows you to invest in property portfolios without actually owning the physical property. So without applying for a bond and owning the bond, it's like you're investing in a company that owns properties and you get a share. So it's almost like you've invested or you've bought a share in a company that owns properties and you get a return on that. So REITs offer more liquidity, but there is obviously market risk depending on the performance of the company. So direct property investment is obviously buying property and renting it out as a property investor. And then with REITs, there are different REITs companies. So Growth Point, Redefine Property listed on JSE. JSE has a list of REITs companies that are listed with them that you can invest and buy REITs in. And then there are commodities, which are physical assets like gold, silver, oil, agricultural. And so those can offer you a portfolio diversification, especially if your portfolio is more focused on equities and bonds. This would kind of give you something different in terms of what you own. So you can invest in physical gold by buying Krugerrands, or you can buy ETFs that track the performance of the commodities, like the Absa New Gold ETF, which tracks the price of gold. And so this is higher risk and has higher market fluctuations, but then the returns can also be really good. Then there's another one, which is cryptocurrencies, things like Bitcoin, Ethereum. They're digital currencies. They operate on a blockchain technology. They're very highly volatile and have gained popularity over the years as an alternative investment class. They're very speculative. They carry extreme risk due to just how quickly they fluctuate. Like, it's insane when you look at a graph. Let's look at Bitcoin quickly. It's so insane. Look at that. It's just crazy how like quickly it moves and how quickly it goes down and then it goes up. Look at where it is now, but look at where it was in June, for example. So with cryptocurrency, it's just really, really like, look at overall, look at where it started and it just dropped back, and now it's kind of picking up momentum, and I anticipate it's going to drop again and it's going to recover and all of that. So it just, the fluctuations here are really, really quick. But there's higher potential returns if you do potentially structure things in the right way. Like, I know some people trade cryptocurrency. Some people, like, the investments are made up of crypto. I don't know how they sleep at night, but do them. And I know a lot of people who invested early in Bitcoin when it did have a really good high. I can't remember around where people were cashing out. I think it was around here in 2021. People were cashing out on their Bitcoins, and some people became millionaires overnight type of situation. So the returns are there, but then the risks are also there, because after this high, look at how low it dropped. It quickly went all the way down. So for those that sold at the right time, they gained. Those that didn't and held, they lost some money. But if they're still holding, they've recovered now, and they actually at a far better position than they were here, in 2021. So it's just all about kind of, with crypto, you need to really be on the pulse. Like, here, you need to be like, know what's happening, check everything. It's just more higher risk. Impact farming, one of my favorites as well, is it involves investing in agriculture, sustainable products like solar farming, keeping investments offer returns based on revenue projected by the project. So they can offer moderate returns and are considerably socially responsible investments. There are risks attached to this, like weather conditions, harvest, market demands, operational challenges, and so on. And I have invested in with Fed Group. I've bought blueberries, macadamia nuts. What else? I think I've got like 3 different types of impact assets. And the nice thing about them is like you own that for the time period or the lifespan of that asset, and you get returns over time. And so I like this. I enjoy this type of investment. So it's a nice diversification. Who's still here? Oh, it's just me and you.
Yeah.
Okay, so there's this notion of timing the market versus time in the market. So timing the market would be kind of looking and Bitcoin every day and kind of seeing, okay, now the price is low, let me buy. Now the price is high, just trying to find always trying to find the right time and the right entry point. And a lot of the times people who time the market would be day traders. So people who do forex trading or commodities trading. And so the notion of long-term investing is more time in the market. So the amount of time you spend in the market, which notionally always says staying invested over the long term is more effective than trying to predict movements, especially as a beginner. And that's why a lot of people lose money when they try forex trading and stuff, because it's very difficult. It's like you have to build the skill over time. And if you're a beginner who doesn't have that skill set and who doesn't understand certain things about investments, it can really be difficult for you to time the market. It's better to spend time in the market than timing the market. And so that's essentially that notion there of having a long-term mindset when it comes to building wealth and not trying to always enter at the right time and exit at the. What I say with that is, if there's a share that you were buying, for example, an ETF that you were buying, and something happens and it drops. So, the S&P 500, for example, when it dropped, and you had money, it would be great to buy. Like, it makes sense to buy at that time because now it's cheaper. You were going to buy it anyway, right? So why not buy it when the price is lower and it's cheaper?
Yeah.
And that's the only way I would kind of react to that type of movement. But I wouldn't be like, oh, I need to buy low, sell high. It's just not a sustainable investment strategy, especially for a beginner. And so this is kind of the approach that I'll take. Like if the share is down and I own the share and I was going to buy more anyway because I invest in that every month available, it's great to buy it when it's low, because then when it goes high like this, you get more back, obviously, because if you're buying here at 5 Rand and now it's gone up to 25 Rand or 10 Rand, you kind of get that return. And even here, when it doesn't drop as low as that, so you still owning some shares at this price is good and better than owning them at here. But it doesn't, if you have the long-term approach, essentially that wouldn't really matter to you because you're buying and investing at any point anyway. But it is beneficial and good for you to buy if the share is low. But I'd only say do that strategy if you were going to buy the share anyway. So might as well just buy it when the share price is low.
I see.
Yeah. So don't try and time it because someone else might see this low relatively as better than this low, for example. Or someone else might be waiting here to buy, or maybe let's say someone else might be waiting here to buy at this low, but then they missed this low, which is better. It was cheaper. Does it make sense?
Buy anyway, like it makes sense. It's an
advantage. Then it takes away that stress.
Yeah, because you were gonna buy anyway. It's like Black Friday. If you're gonna buy anyway, it makes sense to buy at that time.
Yeah.
It
makes sense. Then it's like, yay, great, it's on sale. Like I'm getting a share on sale. Like it's a thumbs up for me. But it doesn't really like I'm always waiting for the share price to drop, then I buy. It's kind of like my strategy is not on that, because I have the plan to always invest and always invest in these things. And so if it's cheaper, I'm happy because then I'm getting more for my money and I can buy more. And it's almost like I'm getting it at a sale. But regardless of what happens, I will still invest.
Oh yeah, definitely. The sale understanding makes perfect sense. Because
Yeah,
if you're gonna buy it anyway, you have money set for that. You know what you're expecting. It's just the bonus that you find it on sale.
absolutely. You get it. You get it.
Yeah, I get it.
And then for me, the emotion, I think because I is okay with risk, I didn't feel too emotionally attached to my investments. So for example, when COVID hit, I didn't panic. I didn't feel some type of way with like losing money and stuff. I just was like, okay, I have money, let me buy more. And it turned in my favor because assets and shares that I bought during COVID are some of the best performing now, for me. So I think for me, I've been able to kind of take the emotion out of that. But for some people, it makes sense that they would feel emotionally attached. And so it's really good to kind of take that from your decision making.
Yeah,
Sorry?
like my understanding from this is that I shouldn't panic. If it goes down, it's like, okay, I'm looking at long term anyways. I don't want to. I'm not in the business of let me sell when it's too high. I'm in the business of let me keep this for some time. It will get better because the
Yeah.
graph show not always down. There will be a
No,
time where it will go
it
up. Yeah,
recovers. Yeah.
yeah,
Because if you look at the S&P 500 maximum, the best time to buy was here in
yeah.
96. Because if you look at how it's performed over time, but then also the second best time is today. Because
Yeah,
this graph is not stopping, it's going to continue.
true.
And so it's
So
better to.
it's never too late to start, basically.
No, absolutely not. It's never too late to start. It's the best time to invest was yesterday. The second best time is today.
Oh yeah.
And so
That's
having
it.
that long term, but also for me, I've been having conversations with myself of, okay, I'm investing for the long term, great. But
Yeah.
what is long term? This was before obviously having kids and having a family. I was like, okay, how far am I going with this? Like, am I gonna cash in on my investments when I'm retiring? Like, what does it look like? Because essentially, you want to also enjoy the fruits of your labor, right? You don't want to just keep investing forever and ever, and then you pass away, and you haven't reaped the benefits of your hard work. And so, I think it's
Yeah.
good to have that type of, okay, this is how I want to do things. This is my thinking around it. My investments, okay, with these type of investments, for example, like impact farming, at the end of the life cycle of that asset, that investment paying, so have to buy again. So with, for example, blueberries last for 8 years. So I know that's an 8-year investment. I'll be reaping the returns up until that point. But other investments can go for a longer period or a longer time. And so it's kind of like, okay, with my ETFs or my TFSA, I'm now having it as a substitute for my retirement. But even then, let's say I max out my TFSA when I'm in my mid 30s or whatever. And then I'm like, okay, I want to retire early. I know that I can live off the returns and from that money before I reach retirement age, for example. So it's kind of like having those type of plans and thoughts. Okay, now if I pass in my world, this is how I would want this to be done. I want my son to get it. I want it to be put in the trust. And so it kind of adds more excitement and more like value to investing. Because I know a lot of the time it's like, oh, I have investments. It's almost like a vanity matrix. A lot of the times I have a net worth of 100,000, I've got a net worth of 1,000,000, or I have a net worth of 7 figures. And it's like, okay, that's great, but what are you going to do with that? Like,
Yeah.
how is it going to service your life? Like, why are you sacrificing today for tomorrow? Like, what is going to happen?
Yeah, because you need to identify your tomorrow.
Yeah.
I like how you mentioned with like different stages of one's life cycle, I'd say. There's retirement, or if I start a family, what sort of plan do I have? Which ones are going to service that part of my life? If I decide to like retire early, which one can I look at to help me, in that regard? Post-retirement one, to have like different pockets and say, okay, if anything happens in the 5 years, this is what I'm looking at. In the next 9-10 years, this is what I'm looking at. 25 years here, and just the rest of it like that. Yeah.
Absolutely. So it's like, yeah, that's all great. Like, why are you investing? Like, what are you doing it for? Are you going to reap your, and I know a lot of times like invest for the long term, but what is long term? How long is long term? Is it 40 years, 50 years, 60 years? Forever until I pass? Like it's adding that, like having those questions and applying it to yourself, your goals, your life, what you want to do, and having the options as well. Like for me, I know that, okay, I'm building an investment portfolio, but I'm no longer thinking about myself. I'm thinking about my son. I don't want him to start from zero. So I want him to inherit, and have generational wealth passed down to him. So whether that's shares, whether that's investments, whether that's property, whatever that looks like, right? But also I need to think about myself in the picture. What if I decide, okay, I've built, a sizable investment portfolio and I want to retire early? Investments can give me that flexibility. I'm going to be able to do that without tapping into my retirement funds or cashing out my retirement annuity. I can live off my returns from my investments.
Beautiful. Yeah. It's making so much sense. It is making so much sense.
I'm happy to hear that.
Yeah, like, I don't know, it just feels like you've literally just, like, I removed the layer. I'm like, okay, now it makes sense. Because I like this idea of investing, but sometimes I'm like, they keep saying long term. Like, I don't even know how long I'm going to live. So what is long term for me?
Yeah.
The longest time I'm like, what is long term? Banks, they talk up to 5 years. That's their long term.
Yeah.
And then you hear of like 20, 15 years. I'm like, I don't wanna sacrifice for the money that I'll never enjoy. Like I'd have to enjoy it at some point.
Yeah. And so
Yeah,
that's all up to you. You can define that for yourself. And I'm currently in the process of defining that for me, because I'm just like, I need to reap, because essentially investing is sacrificing your today for a tomorrow. But then you need to decide when that tomorrow arrives for you. When do you arrive at your tomorrow?
True. Oh my goodness. All right. Yeah. I'm just like,
I'm happy.
oh my.
I'm happy to hear there's some light bulbs going on.
You know how people would go to church or like one service and be like, this is the day I accepted Jesus. It feels just like that for me. It's like,
that's so
like,
good. Please write it on the WhatsApp channel so people can have FOMO and they can attend the investment sessions, because this is my favorite topic. I love talking about this. It's like one of my favorites.
The reason I signed up for this whole course, I was like, because there was something missing about it. I'm like, I love saving money. I love keeping money because, like I said, I have my own fears of not having money. But at the same time, I'm like, when am I going to enjoy this? Like, what's going to happen? What's the end goal?
Yeah.
Like, for the longest time, I've been asking myself, what is the end goal to this life thing of mine? I'm saving. Okay, fine. I want to buy a house. I want to buy this. I want to buy that. And then after getting all those things, and then save for what? Am I going to this life of sacrificing my whole life? And then what's the end goal? Like, what's the end goal?
And it makes sense to think that. Those are good questions, because then you start applying it to, I'm doing this for me. And it makes it so much easier to block the outside noise. What that person is investing in, it doesn't matter. And I think you build that with consistently investing and building confidence. Like for me, in the beginning, when I was starting out, I was like, okay, I'm going to listen to those who have walked the journey before me. But it just got overwhelming really quickly. And I learned, okay, as I'm going through this, I need to define for myself, what are my goals? What do I want? What does that look like for me? And take away the confusion by focusing on ETFs. I was like, okay, that's my system. This is how I do things. I'm going to invest 36,000 a year and max it out. After that, then I can look at other things. But, it makes it so much easier, because then for me, I know each month, there's a plan. I have to max out my TFSA within a year. I can't look at anything else. I can't, because I need to get the tax benefit. So until that has happened, then I can move on to the next thing. Once I've maxed it out, then I can be like, okay, maybe I want to buy impact farming. So maybe let me buy some impact farming. But how long do I want to own those impact farming? What's the return there? Okay, great. I'm happy with that. Maybe, you know, and it's now you start filling up the gaps in your portfolio.
Oh, one more. I wanted to ask with the tax-free savings account.
Yeah.
Should I be worried that maybe one day, because government regulations changes every now and again, yes, they feel so pumped up that they want to encourage us to save money and all of that. Are they not going to wake up, since it's going to take me about 13 to 14 years to max it out? Are they not going to wake up in year 8 and be like, actually, we need to start taxing these people? Like, this thing of not taxing them because of this amount of money, it's not working for South Africa.
I mean, that does exist, but I don't think then they would go back in time, because obviously the rules were different. It'll just be kind of anything going forward if they do decide to change it. But I doubt that they will, because it's a good incentive. It does improve investors. What is it? Like international investors is like one of those benefits that we get, like almost like a tax rebate type of thing. It helps money flow in the market, because remember, if you are investing, you are contributing positively towards the economy. So they would be shooting themselves in the foot if they did that. So I don't think they're going to look at taxing. I anticipate they're going to increase the limit. So instead of 36,000, they might say, okay, we're increasing it to 38,000 a year, or kind of give more of a benefit.
To have more money circulating and coming.
Yeah, I don't think they're gonna, but you never know. Well, they currently do tax 40% if you go over the limit, so they are getting the most out of that. If you do go over the 36,000 rand limit at the moment, they said they've taxed quite high.
All right, brilliant.
Yeah.
Okay. Oh my word. It sounds like a lot. I just feel so relieved. Oh my word.
It's a lot to digest, but I'm glad you have the questions, because it's that you are thinking about it and it is an interest. But I need you to get over that fear.
Okay.
Yeah. Start small.
Yeah.
Start with something simple. Start small.
Yeah.
And then
like TFSA, and then I go to my ETFs. Just like you said, like I just want to do it one step at a time and tick off things as I go and say, okay, I've done this, I've done that. Yeah.
Yeah. And then that's it. And then over time, you'll thank yourself. Future, you will thank you by diversifying.
Yeah. Well, thank you so much, Miranda.
No problem, girl. In our session here, we actually have gone over quite a bit, but it was a really helpful session. Thank you for joining, asking all the questions. Please write in the group.
I will. I will. Definitely.
They have FOMO. All those that weren't here today, and to feel like, yo, I missed out.
No, I will.
All right, girl, get some rest.
All right, thank you. Bye.
Okay, bye.